What's going on, everyone? I want to discuss selling puts on stocks even if you have a small portfolio. I know so many people out there are trying to grow their small portfolios, and this video is going to be for you. So if you can't afford selling put options on some of your favorite stocks, this is going to be a workaround, a cheat code, a way where you can actually sell put options with way less capital and actually still get a really good return. And actually, it's going to be a higher return. So I am really excited to get into this video. As always, leaving a like on the video is greatly appreciated. It helps my video reach more people in the YouTube algorithm. And I also have a Discord community, which you can always check out in the first link in the description. Just please stick through this video so you know how to close this position. I'm going to be going through a very detailed process on how this option position works and how to properly close it. I'm also going to be using some technical analysis, which you're also going to learn in this video. And I'm going to give you some best practices on how I am profitable selling these type of positions. All right, so let's go into an example. I'm going to type in Tesla stock right here. Tesla is obviously an amazing stock. Tesla is a very popular stock. However, Tesla is a very expensive stock. So one of the biggest problems for most people is Tesla's $719. Well, selling a put option requires you to have collateral. Now, you need 100 shares worth of collateral because each option is 100 shares. That is going to translate into $71,900. Even if I sell a put that is out of the money. So let's pick a put option that is very out of the money. So let's go over to sell put option. Let's go to expiration date, and let's just say we're going to go for a July 15 put option. So I've opened up the option chain. I'm looking at the 650 strike, which is out of the money. The current stock price is $719. But even this right here, if I go ahead and sell this put option right now, you can see that the total credit is $28. In fact, it's $2,800. However, the big problem for many small portfolios is you really need about $62,140. That is a lot of money that small account portfolios are not going to have available. So selling puts on Tesla is out of the question, or is it? Well, I'm going to show you a genius way to fix and find a solution for selling put options on your favorite stocks that are expensive. So whether it's Tesla, which is over a $62,000 investment, or maybe it's some other stocks that are even cheaper than Tesla, like Amazon or Apple, these stocks are still five-figure investments, right? $10,000 or $15,000. And let's say that you're only trading with a few $1,000s or even less, a few $100s, and you can't afford to sell a put option. Well, I'm going to show you a way around this, and in fact, this is a very attractive strategy that I'm continuously using on a weekly basis with my Discord students. But first, to understand how this strategy works, how to reduce your cost, I want to first educate you on selling this put option right here. You'll notice that I'm collecting $2,860, but I am risking $62,140. Now, this is a 650 strike. I want to click off of this for 1 sec. I actually want to go over some technical analysis with you on Tesla stock so we can pick a proper strike price, so then I can show you the strategy. And this strategy is going to be way less risk. In fact, selling put options is a really big risk in terms of the amount of collateral that you're putting up. The collateral that you have to put up with selling put options is just not feasible for many small portfolios, and the risk involved is also not that small, because if you're selling a put option, even if you do have $5,000 or $10,000, selling a put option ties up a lot of capital, so then you're left with a very big position relative to your portfolio. So not only is it an issue to open up a put option because a small portfolio has limited capital, but even when you do open up a sell put option, then it becomes too large of a position in your portfolio. There's many issues here, and these problems need to be solved, and I have the perfect way to do it. We're actually going to use the same stock. We're still going to use Tesla stock for this example, but first I want to find the price at which strike price we're going to sell this new strategy. So going over into Yahoo Finance, I want to show you the Bollinger Band, because we want this stock to stay above the strike that we pick. But what strike do we pick? What is the optimal strike that we can pick so we're safe not only selling a put option, but selling a put option at the strike for this new strategy that I'm going to show you? So to determine that, we really need to find what is a likely support level for Tesla stock. So again, currently the stock is trading for around $719 or about $720 in pre-market trading. And now what I want to do is I want to show you is literally the best method for finding a support level. Sure, you can draw a chart, like we see a double bottom right here at 647 and then 639, but I have an even better way to find a support level for any stock. So for Tesla, the way we're going to do this is we're going to go into the indicators right here. Now, the indicator that I want to use is called the Bollinger Band. This Bollinger Band right here basically looks at the stock's volatility and then it creates a band. Now, when you look at this band, when I show you in just a second, this band will contain a certain amount of information for where the stock is likely to trade within, okay? It really depends on the standard deviation right here. Now, the standard deviation is pretty simple. One standard deviation means 68% of the time, the stock is gonna be in that range. Let me actually show you what one standard deviation looks like. So if I save this one standard deviation, you'll see we now have a yellow band right here. And this band right here is showing you what trading range Tesla is likely to stay within. So if I'm going to be selling a put or this new strategy that I'm going to show you, when I'm going to be selling that strike price, then I want it to be at least 660 or below if I'm trying to protect myself against the stock falling lower than this level. Now, if I wanted to protect the upside, which I don't in this example, but that would be 741. Now, what I want to do is I want to go back into the Bollinger Band. So I don't typically use a standard deviation of 1 because, again, a standard deviation of 1 means I'm going to capture about 68% of the movement for Tesla stock. Now, 68% of the movement isn't too bad, but I really want to be safer than that. I really want to expand the band and I want it to be big enough where I am safer than 68%. So what I'm going to do is I'm going to put 2 standard deviations. Now, 2 standard deviations is going to capture about 95% of the data. So now 95% of the time, you're going to be safe with the stock trading within this range. So this is obviously a very high probability range to be within. So 95% of the time, you're going to be correct, and 5% of the time, it could break this range. And that's why it's so important to know how to manage this position, as I will get into in just a few moments after I show you how to pick the strike price. So now you will see that this yellow band right here has actually expanded. It has gone up on the upside, and on the downside, it has also expanded down to about $619 per share for a Tesla. Now, again, I picked 2 standard deviations, so this Bollinger Band is now going to capture 95% of the data, and that is very good for me, okay? That is a level where I'm very confident that literally 19 out of 20 trades are going to be successful. So now we have a strike price of $619. This is how I'm going to pick my strike price. I'm going to now go back into Robinhood, and instead of picking the 650, I have so much more information and so much more data in my hands to understand where could a potential bottom be for Tesla stock. What is a strong support level? Now, I'm going to use about a 620 strike price right now because it was about $619.66. If I go back here and check, yep, that is correct. So I'm going to use a 620 strike price. This is the level where I don't think the stock can go below. And I am 95% certain because the Bollinger Band that I used is 2 standard deviations, which is a 95% confidence interval. So now I'm going to show you how to modify and find the easy solution for selling put options with a small account. If you have a small account, you no longer have to worry about having less money and being at a disadvantage. I'm going to show you how we can switch over to selling a put option and still sell a put option, but now make it way less costly. Okay, so we're gonna now sell the $620 put option. And again, to review, we're actually collecting a lot of money, $20.93, which is $2,000. But again, the problem is $59,910. So now I'm gonna show you how to easily modify this sell put position and create a much smaller order, okay? So what we want to do is buy a lower put option. I'm going to now go to buy a put option, but now I'm going to buy a lower put option. I'm going to show you how to play around with these strikes, but the cheapest way to really do this is to pick the next leg down, which would be a 615 strike price right here. Now, this is going to cost us some money, but I'm going to show you why this is so advantageous. So now I'm going to go ahead and buy the 615. We want to buy the lower strike, and the difference in strike right here is only $5, okay? This is very important. The difference with 620 and 615 is now your new collateral, because guess what? Now you don't actually have all that risk. You don't actually have to take shares of 100 shares on $620 because you have now bought a put option protecting your downside. So even if the stock were to crash, you don't have to worry because now you're protected with the 615 strike. Now, if you'll notice, our max loss is even less than $500. And that's because our collateral is actually still $500, but now we're collecting $133. So if we take $500 and subtract $133, $633, we only have a max loss of $367. This is way cheaper. In fact, it was about $59,000 before, $60,000. And now even a tiny portfolio with $367 can now sell put options on Tesla with this new strategy, which is a put credit spread. This makes it way cheaper. There's actually a lot of similarities between selling a put option and selling a put credit spread. In fact, all of the mechanics are basically the same as selling a put option, but now you protect yourself with buying a put option one strike lower than the one that you have sold. This protects your downside. It reduces the maximum loss or the collateral that you have to put up. And in fact, if you do the math right now, before we were collecting about $2,000 on $60,000, which is about a 3.3% return. But now we're actually getting a $133 return divided by our collateral that we're putting up at $367, and we're going to have an over 35% return. In fact, it's a 36.2% return when I look at my calculator. So this position will help you double your portfolio if you get it right 3 times. However, the Bollinger Band said that you're going to be winning this trade about 95% of the time. So out of 20 times, if you sell a put credit spread here in this example, 19 times $133 of profit each time is going to be $2,527 in return. And one time you're going to lose $367, but you're still going to have a profit of over $2,000. You still have to put up some collateral. This is not a free strategy, but here is the new return that you're getting is $133, which is way better than just selling a put option. This is a super strategy for a small account. For anyone trading less than $30,000 or even less than $20,000, or heck, even if you have a few $100s, this is going to be a very good strategy for scaling a small portfolio and building it up quickly. Now, using that Bollinger Band is going to help you pick the strike price at which you want to execute on this strategy. Now we need to discuss closing this position. This is really what's going to wrap it up and give you the most success with this strategy, okay? So closing the position gets pretty complicated because there's many ways to do it. There's no one size fits all. However, I'm going to give you the best practices. So for example, this position right here is going to be profitable so long as Tesla stays above $620 per share. So let's say that expiration is approaching, a couple of weeks have passed. Even if Tesla stock fell down to $650 per share, so long as it stays above $620 per share, you're going to be okay. And I would keep holding this position. I would leave it open and not bother closing it so long as the stock stays above $620 per share. As long as it's above this price, then you're safe and this option is going to continue making money. The put credit spread is going to continue decaying in value, which is a benefit to you because you have sold it, collected premium. As long as it's approaching expiration and away from $620 per share, then you're going to end up being profitable. But what happens if it touches $620 per share or goes lower? So if the stock approaches $620 and hits $620 per share, that is going to be an in the money option, and that's a very bad thing for you. Luckily, this is only going to happen about 1 out of 20 times based off of the Bollinger Band. But when this happens, when it hits $620 per share, that is when I would personally start looking at closing this position because you have a lot of risk and you can lose a lot of money. And if this position hits $620 per share, but you still have a few days until expiration or even a couple of weeks, if Tesla has a big move, that's actually beneficial for you because the 615 strike put option is going to have some value. So you can just close this position and not lose your entire collateral of $367. In fact, most of the time you're going to close this position and only lose about half of the $367, which is a very big benefit. And again, that happens because this 615 put option that you have bought is going to increase in value. So my typical exit point or how I would close this position is if the stock were to hit $620 or even $621, when it's around this range of the top of my strike price, the 620, not the 615, when it's around the 620, then I'm going to close the position because it's at risk at that point. It's so close to $620. It is at a risky position for me. Then I'm going to close this position. And again, I'm going to close it not for a full $367 loss because this 615 put option is actually going to have some value. There's some more strategies that are a little bit more complex like rolling, which you can also implement. I'm going to have a video for you right here on the screen that you can check out on rolling options.